If you're self-employed, operate your business as an S corporation, and you might want a mortgage someday, this video is for you. In it, I'm going to explain exactly how lenders like me will calculate your income. And seeing your income through the lens that lenders use makes the lending process so much easier and a whole lot less frustrating, which is nice, but I'm kind of hoping you found this video while you're in planning mode, because planning ahead for a home purchase is always important, but it's extra important when you're self-employed. So here's what's ahead. First, I'm going to run through the paperwork you need to gather up, and then I'll share exactly how lenders analyze each document, and I'll close out the video with an example. Stick around to the end and you can watch me calculate income for a sample S-Corp step by step. And if you have your own tax returns handy, you can even follow along and calculate your own income exactly like a lender will. But a precursor to the math, which is really important, is that I'm going to share the logic behind the calculations we're going to be doing. And this information is just worth its weight in gold. Once you know the why behind the math and you understand what parts of your income do and don't count toward loan qualifying, you're going to have a chance to effectively plan ahead and maximize your loan qualifying income so you can get that home you really love while still minimizing your tax bills. You don't have to pay an arm and a leg to Uncle Sam. So let's get started. First, with a little bit of housekeeping. This video is for you if you're self-employed and your business is set up as an S corporation. And if you're not sure how your business is structured, just hit pause, go grab your tax returns for yourself and for your business. And if your business is filing its return on a separate tax return from yours on a form called 1120S, and that form number is going to be in the upper left corner of your tax return, you're set up as an S-Corp. Just because you have an ownership interest in an S-Corp, it doesn't automatically follow that you'll be considered self-employed when you apply for a loan. For mortgage purposes, you're only self-employed if you own 25% or more of a business. If you're not sure about your percentage of ownership, look through your business tax return, flip through looking for a K1 statement that has your name on it, and in Part 2, Box G, you're going to see your percentage of ownership. Anything less than 25%, and you're not technically considered self-employed, but I'm still glad you found this video, because there are instances when some of the rules for self-employed people might apply to you. Before counting the profits on your K1 as income for loan qualifying purposes, some mortgages will require that we either show those profits have been distributed to you or the business will have to pass what's called a liquidity test. And I'll talk about this a little more in this video and a lot more in another video. Now, if you file a separate tax return, but it's on Form 1065, that's what you see in the upper left corner of your tax filing, you're set up as a partnership, not an S-Corp. And if all of your business income and expenses show up on your personal income tax returns on a form called Schedule C, and you don't file a separate business tax return at all, then you're a sole proprietor. And in either of these cases, this video isn't for you, but don't worry, I've got you covered. This video is part of a playlist, and in this playlist, I'm trying to cover all things self-employed. So just pop down to the caption, click the link for your business type, or if I haven't yet recorded the video for your business structure, just subscribe and turn on notifications. And while you're down there in the caption, I should mention you can find my contact information. If any of what I'm sharing in these videos is helpful, imagine how useful I can be in real life. I really love helping self-employed clients and freelancers navigate the mortgage process, so reach out anytime. I would be thrilled to bits to talk. So let's get to it, starting with documentation, because really, unfortunately, I guess the first step in getting pre-approved for a mortgage is always corralling the right paperwork and sharing it with a lender. So what we'll need always is 1 or 2 years of your personal income tax returns, 1 or 2 years of your business income tax returns. And if you've paid yourself a salary out of the business, we also want your W-2 statements. And then depending on the circumstances, there are a couple other things that we might want to get: extension forms, a profit and loss statement, and a balance sheet. And when a lender asks for documents, including tax returns, make sure you send the entire document. Tax forms, when you're self-employed, can be a little burly, but we really need the whole thing. And you're going to see why as we get into the calculations and looking at some of the tax returns. You'll see we need all of those pages. W-2s are required kind of as an adjunct to your tax return. Without those W-2s, we can't see all the income that your business paid out to you. We need extension forms if you're past the standard filing date for a return and it's not yet submitted to the IRS. So starting on March 15th of every year, if your tax return for the previous year isn't filed for your business, we'll want a copy of Form 7004. That's the extension form for a business. And then after April 15th of every year, we'll want a copy of Form 4868, which is the extension form for personal tax returns. And you are, just as a note, probably going to have to ask your accountant to send a copy of these. For some reason, when they file them, they don't seem to share them, so you'll have to probably make a request. Now, a profit and loss statement, or P&L for short, is a financial statement that shows your income, your expenses, and then income minus expenses is your net profit over a period of time. FHA, VA, USDA, and some jumbo loans require a P&L if more than 3 months has passed since the ending date of your last tax return that you filed. If a P&L is required, it's going to start at that ending date for your last filed tax return and run through the most recent quarter. So as an example, let's say it's August and you do have the previous year's tax return filed, your P&L needs to start January 1st and then run through June 30th, which would be the end of that most recent quarter. And a balance sheet is a financial statement that shows a snapshot of your business assets, liabilities, and net worth. So it's really assets minus liabilities equals net worth at a moment in time. And FHA, VA, and some jumbo loans require a balance sheet. So now that we have all the right paperwork gathered up, let's talk about where we're headed, what we're trying to do with it. Your lender's big picture goal is to understand the cash flow your business generates and either pays to you or could pay to you. Actual money in, money out, and money left over and accessible to you, because it's that money that's left over that you can tap into to pay your bills, including this new mortgage that you want, groceries, put gas in the tank, and so on. So keep this big picture goal in mind. It's cash flow that's accessible to you. And that'll help make sense of some of what can otherwise be a little bit confusing about the rules around self-employed income analysis that lie ahead. So now let's take a closer look at the documents that we gathered up. First, I want to explore the relationship between your personal and your business tax returns. An S Corp is a pass-through entity. You report all of your income and expenses for your business on the business tax return, but it doesn't pay any income taxes. Instead, it issues a K-1 statement to you and to any other owners of the business. Technically, y'all are called shareholders, and the profits that are reported on the K-1 flow through to your personal tax return, and that's where you pay taxes on them at your personal income tax rate. If you own 100% of the business, all the profits are going to show up on your K-1. If there are other shareholders, the profits are going to be divvied up according to your percentage of ownership. But just because your K-1 shows a profit, that doesn't automatically mean the profit can be used as part of your loan qualifying income. As an owner of a pass-through entity, you and any other shareholders are going to personally pay taxes on every single penny of profit your business generates, but that doesn't mean those profits were actually accessible to you. Your business can earn a profit and pass it through to you so you pay taxes on it and not count as loan qualifying income. And I know that sounds kind of weird, but for profits to count as income, a lot of loan programs require that we prove that your business either did or could have distributed the profits to you. And if you think about this from a lender's perspective, there is some logic to this. We care about what you're gonna have available to pay your mortgages and other bills. So let's say you turn a profit, but you leave it sitting in a business bank account, it's liquid, it's cash. Well, that money is probably available to you. Whenever you want it, you could tap into it and pull it out. But what if instead you invested profits into expanding the business or paying down debt or something else and it's tied up? Those profits aren't available for you to tap into. So we'll come back to this idea when we analyze tax returns together, but it's an important one to understand. Now, one way you're probably paying yourself is with a salary. And when you work for someone else, lenders take your salary that your employer pays to you totally at face value. But when you work for yourself, it's not quite that simple. I really wish it was. But we need to place your salary into the bigger cash flow picture for your business. So let's take a closer look at Form 1120S, and you'll notice that that first page is basically just a profit and loss statement. Your gross receipts or income get reported at the top, expenses are all listed out and subtracted, and then the income minus the expenses equals your net profit, which is called ordinary business income on this tax document. If your expenses are more than your income, your business might show a loss. Actually, I guess it would show a loss. And although that sounds kind of like a disaster when it comes to qualifying for a loan, definitely don't panic, because as weird as it sounds, even if your business shows a loss, you could still have plenty of income to qualify for a mortgage. And to understand this, we want to take a closer look at all of those expenses. And you'll notice that one of them, maybe the bigger one of them, is you. The wages you pay to yourself show up as an expense on line 7 under compensation to officers. Now remember the goal we're keeping in mind. As a lender, we want to know the cash flow your business generates. So let's say your business generated $150,000 of income after all expenses were paid. If you paid yourself $150,000 salary, your business would show zero profit. But let's say you paid yourself a $50,000 salary. Well, now your business is going to show a $100,000 profit. But what if you paid yourself a $200,000 salary? Well, your business would just show a $50,000 loss, right? But to a lender, this is all the same. Every single one of these is exactly the same. They're all $150,000 of cash flow for the year. What we care about is the aggregate cash flow, not how you and your CPA decide to divide it up and report it to the IRS when you file taxes. Now, this is also why your salary right now today, what you're paying yourself at the moment, isn't relevant to your loan qualifying income. I've had lots of self-employed clients over the years to whom this comes as a relief, because they're worried that the low salary that they're paying themselves out of their business is going to hurt their chances of getting a loan. I've also had other clients who are bummed out to hear that they can't just give themselves a raise to help qualify for a mortgage. Neither one of these things really matters or makes a difference, because we have to see how your salary fits into the overall cash flow for your business, and we only get that fully contextualized, big picture, one time a year when you file your income tax return. But there is some good news when it comes to your salary, because wages that you paid out to yourself are always going to count toward the income that we can use to qualify you for a loan. And that's not always true when it comes to the remaining profits. Profits might be part of your qualifying income, but for a lot of loans, that's only to the extent that they were distributed to you, or that your business can pass what's called a liquidity test. And before we kind of get into talking about what profits can count and what can't count and why, we should probably take a break and talk about, okay, how do we actually calculate them? So needless to say, you and your accountant work pretty hard every year to find as many write-offs as you can. And everyone in my family is an entrepreneur, and I'm married to a freelancer, so I completely know this game and understand it. But as nice as that super low income feels, when you file your income tax return, every dollar that you're writing off is a dollar you're taking away from your income. And it can reduce what you have to qualify for a mortgage, except when it doesn't. Lenders don't just take that net profit from your tax return and run with it. We actually make some adjustments to it. And helping understand these adjustments is actually the really big reason, one of the biggest reasons that I'm recording this video, because once you and your CPA see the adjustments lenders make and understand them, you can work together to strategically categorize your expenses in a way that's accurate, but may give your income a big boost when it comes to qualifying for a mortgage. So why is it that we lenders are going to make these adjustments? Well, remember our goal is to figure out the cash flow that your business generates, right? And that makes your tax return a really great place to start, because you're legally obligated to accurately report your income and your expenses to the IRS. But the bottom line on your tax return probably doesn't perfectly align with your actual cash flow. And this is because tax rules really muddy the waters. In some cases, the IRS will let you write off expenses that weren't actually a check you wrote. You get a tax deduction, but there isn't actually any money leaving your bank account. In other cases, You write a check, money leaves your bank account, but the IRS rules don't let you claim a tax deduction. And so we have to adjust for this stuff to find your actual true cash flow. And another factor also comes into play, which is that lenders only count income that we can trust will be there to pay your mortgage month in and month out for years to come. And so we're going to comb through your tax returns and look for income and expenses that look like they're a one-off, stuff that probably isn't likely to be part of the ongoing, long-term, stable and continuing picture for your business income. So let's talk about these adjustments, and then I'll show you how they look in action. Again, we're going to calculate income for an S Corp. So for starters, I want to focus on the rules for conventional conforming loans. And I'm starting with these for a reason. They're the loans that we lenders fund using money from Fannie Mae or Freddie Mac, and they cover about 70% of all mortgages. So they really cover the bulk of the loans you might be getting when you're applying for a loan. But I will take a minute to point out the key differences for some other loan types, because there are some really important key differences. So first, I want to talk about the good stuff. These are the non-cash flow expenses that we get to add back to your income. I think of these as the have your cake and eat it too Marie Antoinette write-offs. You can go crazy, deduct as much as you want, bring your taxable income down as low as you can, save a bunch of money on taxes, and then when you apply for a loan and your lender figures out your income, we're going to add these items right back in again. They have zero impact on your qualifying income. So what are these magical deductions? They are depletion, amortization, depreciation. Depletion isn't something that I get to see very often. It's only applicable if your business involves the extraction of natural resources like gas, oil, timber, mining, quarrying, something like that. You can claim a depletion write-off on your taxes for using up this resource over time. But if you think about this idea from kind of a cash flow standpoint, it makes sense that we would add that back, because just having fewer trees to cut down or less rocks you can quarry isn't an expense that your business actually writes a check for. So lenders add depletion back to your income. Amortization is actually quite a bit like depletion, but instead of adjusting for something you're using up in the physical world, like rocks or trees, it's tied to intangible assets. So if your business holds a patent or a license that only lasts for a certain period of time, IRS rules will probably allow you to claim a tax write-off for the cost over time. And amortization is also a place where you could write off startup costs. By definition, a startup expense happens before your business is up and running. And so if there's no business yet, there's no way to write off the expense. So if you spend money getting your business off the ground, doing market research, working with consultants, advertising before you get rolling, any of that stuff that happens before your business launches, you might be able to write these costs off later as amortization. And because they predate your business and they didn't affect today's ongoing cash flow picture, we can add amortization back to your income. But by far, the most common non-cash flow expense we see is depreciation. Your business probably owns some stuff. And if you're a consultant or a designer, that could be really minimal: a laptop, monitor, printer, desk, chair. But if your business involves a lot of gear, like maybe a photographer, or you're a contractor and you have a lot of equipment, or you manufacture things and you have machinery, your business might own a whole lot of really expensive stuff. And these assets aren't really an expense in kind of the classic sense. They're not like the toner for the printer that you run, or the cost of running an ad where it's a one and done and gone. Instead, they're these objects that you can use over and over again, probably over a period of years. So when you put an asset into business use, the IRS lets you write off the cost of that asset spread out over time as depreciation. And no matter how big or small that depreciation is that you're writing off on your taxes, we'll add it back into your bottom line. Now, IRS rules do allow certain lower cost items, usually the threshold is $2,500, to be written off as an expense the year you buy them. And tax-wise, that feels really good because you get more bang for your buck in the very year that you spent the money. So if you write off your new laptop as an office expense, it really reduces your qualifying income by that amount in that full year. But because you're not claiming it as depreciation, then I can't add that back. So you really want to think about, if you're preparing for a mortgage, capitalizing and depreciating those sorts of assets. Now, so far I've only talked about all the things that we add back to your income, but there is an expense that goes the other way. And these are write-offs for meals, travel, and entertainment, or really more specifically, disallowed meals, travel, and entertainment. If you wine and dine clients or entertain clients, IRS rules usually limit the amount that you can write off for meals and drinks and food and things like that to 50% of what you actually spent. And if you buy tickets to like a show or a sporting event, the IRS won't usually let you write off the admission, but they probably will let you write off food and drinks that you consumed while you were at whatever the event was. Now, just because these IRS rules won't let you write off the full tab for these sorts of expenses, they still affect your cash flow. There's still money that went out. So lenders subtract any disallowed amount from your income. Now that wraps up the cash flow related expenses, but it brings us to our second category of adjustments. And these are the ones for non-recurring income and non-recurring expenses. Lenders only want to count, like I said before, income that we believe will continue. And our threshold, the test for that, is we need to feel confident it's reasonable to assume that it will continue for at least 3 years after your loan closes. And this idea, what we call continuance, is something I talk about at more length in another video that covers more general lending principles for self-employed people. I'll put a link to that above, actually, in case you want to check it out. But one way that continuance really comes into play is if any of your income is listed under other income, separate from your gross receipts. To a lender, other income is instantly suspect. Unless you can show the source of this income is related to your business and that it's likely to keep happening into the future, it's going to get subtracted from your income for loan qualifying. All sorts of things can show up in this category. Maybe you use a rebate card for purchases. The rebates would show up there, but they're not related to your business. Or maybe you sold some business property, equipment, or a building or something, and you made a profit on that. You're going to report that profit to the IRS, but it's probably not a recurring event. Unless you can prove it is, it's going to be deducted from your income. But other income can be recurring. One example that pops to mind when I think about this is a client who's a property manager. The majority of his income comes from management fees, of course, that's what he does, but every so often, every few times a year, one of his clients will sell a property and he earns a real estate commission for helping him sell the property. That gets recorded as other income, but it's something that happens on a regular basis, and so it can be used as loan qualifying income. Of course, just like there are non-recurring sources of income that we want to subtract from your income, on the flip side of the coin, there can be non-recurring expenses that we can add back to your income. If an expense isn't likely to keep happening, we can add it back. Casualty losses are something we can automatically add back. Not to jinx you or anything, but if you suffered losses from a fire, hurricane, flood, some other natural disaster, those are probably a one-off, and we can typically add those back. We can often add back expenses for theft as well, but not always. Let's say you run a candy shop, and every year little hooligans sneak away with 10% of your inventory, slip it into their pockets and walk out, and you're writing these losses off. That's a recurring expense for that type of business, and that would be an example of theft that we couldn't add back. Other non-recurring expenses, of course, can exist, but they can be a little bit tricky to document, and you probably are going to have to point them out to your lender. If you know your business had some one-time expense that was unusual for a year in the tax returns you're providing to us, bring it up. Maybe you moved offices or paid for some professional services, legal or consulting fees or something like that tied to an unusual situation. If you can prove that expense isn't likely to happen again, an underwriter might be willing to add it back to your income. This can be a little bit of an uphill battle, I can tell you from experience, but if you have some good supporting documentation and an explanation, we can make a case. Now there's one more additional and potentially huge thing that lenders look for when combing through your tax returns, and that's short-term debts. If your business has a debt that's coming due in the next 12 months or less, meeting that obligation, paying that debt off, could create a cash crunch. So if your accountant has included short-term debts on your tax return, we're going to find them, and our first inclination is going to be to deduct them from your income. And this adjustment can be a really significant source of frustration. A lot of tax preparers seem to list debts that aren't actually short-term debts on this line of your tax returns where this goes. So getting clear about what's listed on your business's tax filing and why it's there is really important. With evidence that a debt shown as short-term actually rolls over, like a line of credit would be a good example of this, or it isn't short-term at all, if it's a mortgage, we can work around this adjustment and not subtract this line item from your income. But the workaround generally requires having your CPA write a letter. And most CPAs get really surly when a lender asks for a letter explaining something. They call these lender comfort letters, and there is a bit of a long-running, low-key feud between CPAs and mortgage lenders over these things. CPAs just don't like writing letters for lending purposes. The other option we have is to show your business has sufficient liquidity to cover any debts that are coming due in the next year. But if you had sufficient cash sitting in the bank to pay off your mortgage or your credit line, why would you have a mortgage or a credit line? So that could be a problem as well. So given the potentially huge adjustment and negative impact on your income that this line item can have, it is really important to check your tax returns for short-term debt, talk to your accountant about what's listed there and why. And I'll show you where to look when we look at tax returns, our sample tax return in a minute here. So that wraps up all the Fannie Mae and Freddie Mac rules. But as promised, I wanted to circle back to talking about a few key differences when we talk about other types of loan programs. So next most common loan is probably an FHA loan, and FHA loans are different in a couple of key ways. For one, FHA always requires 2 years of tax returns for yourself and your business, and you'll need to prepare a profit and loss statement if more than 3 months has passed since the ending date of your last tax filing, and we'll also always want a balance sheet. But really notably, and this is good news, FHA doesn't require a liquidity test. If your business shows a profit, after all the usual adjustments we just talked about, your share of that profit is going to count as loan qualifying income. VA loans also always require 2 years of tax returns and a profit and loss statement and a balance sheet, but the adjustments lenders make on VA loans are much simpler. That kind of sounds like a good thing, but in this case it isn't. The only thing they let us add back or adjust is depreciation. That's it. Now, depreciation is usually the biggest adjustment, but if one of those other adjustments, like depletion, plays a big role in your expenses, your qualifying income for a VA loan could be lower than any other type of loan. But by far, the most important and honestly really weird thing to know about VA rules around self-employment is that losses claimed for a business that your spouse runs always have to be deducted from your loan qualifying income. And that's true even if your spouse isn't on the mortgage or purchasing the home with you. The only workaround to this really unique requirement that the VA has is to file separate tax returns. Now, on the plus side, the VA is super flexible when it comes to debt to income ratios. So the odds are actually kind of high that even though your debt to income ratio could be higher on a VA loan, there's a good chance you'll still qualify for the loan you want. And USDA loans keep things really simple by just following Fannie Mae and Freddie Mac guidelines. So everything I talked about before would be applicable if you're applying for a USDA loan. Now, jumbo loans, on the other hand, are a huge mixed bag. A lot of them follow Fannie Mae rules, but not all. And many jumbo loans require that we prove distribution of profits or your business has to pass a liquidity test, but not all. And a few of the really more conservative jumbo lenders may follow these extra stringent standards laid out in the Consumer Finance Protection Bureau's Appendix Q. There's just oodles of variability. So if you're interested in borrowing more than the Fannie Mae loan limits allow, start the pre-approval process early. So there's plenty of time for you and your lender to gather all the information and find a good fit between your goals and your business profile and just the right jumbo loan program. And I would be more than happy to assist with this project, of course. Feel free to reach out anytime if you have questions about your own situation. So that's a wrap on all the concepts. It's enough, right? So are you ready to see everything in action? As promised, we're going to calculate income for an S corporation together. The business we'll be analyzing is Los Pollos Hermanos. It's an S Corp with 2 shareholders, Gus Fring and his business partner, Max Arcenega. The business opened in 2008 and runs a chain selling fried chicken. It's a restaurant fast food chain. Maybe you've heard of it. Gus wants to buy a new home using a conventional loan because his business has been operating for more than 5 years. Fannie Mae rules actually only require that we analyze 1 year of income tax returns. So let's dig in. Here's Gus's 2023 personal income tax return on the right and the tax return for Los Pollos Hermanos on the left. So in the real world, when a client sends me a bunch of paperwork, it's a little bit like unwrapping a gift. I don't know what I'm going to get. Now, in this case, I made these tax returns. I know it's an 1120S, it's an S Corp because that's what we're here to talk about. But in the real world, I would look at the personal income tax return first, Form 1040, to try and figure out what's going on and what other documentation am I going to need. And on the front page, I'm going to see, hey, we've got, our borrower, Gus Fring, earned $150,000 of wages, so he may not be self-employed. I don't necessarily know that, but I've got my first hint that he might be when I see this $258,000 here of other earned income. And I just made a really abbreviated version of tax returns here. I'm not a CPA, so I honestly couldn't put together a full set of tax returns. But when I see that 258, I'm going to start scrolling back, and there's going to be a bunch of pages and things, but there are just a couple things that I'm looking for. And in this case, the place I would settle, where I would quickly figure out that I'm dealing with an S Corp and I need the tax returns for it, is this form called Schedule E, and it's page 2 of Schedule E. If you have rental property or royalties, then that'll show up on page 1 of Schedule E, but income from partnerships, trusts, and S corporations shows up on Schedule E. This is pass-through income from these other types of entities that don't pay taxes themselves. And if I look at line A, I'll see, Los Pollos Hermanos, there's a business here, and what kind of business is it? Well, in this column, if it was a partnership, there would be a P, but we see an S, so we know it's an S Corp. And we've got the EIN for the company, and we can see on the corresponding line A down here with the passive and with the income and losses that there's $258,000 of pass-through income that came from a K-1 statement. And that is basically it. That's all that we need to know about the personal tax returns. I will, because I see this W-2 income, want to get a copy of the W-2. Here that is, $150,000 of income paid from Los Pollos Hermanos to Gus. Theoretically, that could have been income from some other job, but now I know, that's some income that came from this same business that I presume my client might own. But first I have to look at percentage of ownership, right? So when we jump over, and I'm gonna, that'll be it for Gus's personal documents. I'm actually gonna switch tabs and start working in this spreadsheet that you see here. This spreadsheet is something that I made, and if you like it while I'm playing with it, feel free to reach out for a copy of it. I'd be happy to send you one. But it's based on Fannie Mae Form 1084, which is Fannie Mae's worksheet where they outline the cash flow analysis that they want lenders to do. And so I'm using Fannie Mae's formulas here on this spreadsheet. And I'm going to jump over to looking at the 1120S for this business. And the very first thing that I want to look for isn't actually on this front page, unlike the 1040 where we want to look at the front page first. It's actually further in. I'm going to scroll back until I find the Form K-1, Schedule K-1, Form 1120S, that corresponds to my borrower. So in this case, Part 1 of the K-1 is going to tell me about the business, Los Pollos Hermanos, and there are 100 shares outstanding. And Part 2 is where I'm going to see that this is Gus's K-1, the pass-through from Los Pollos Hermanos that reports over on Gus's personal tax return. And there are 50 shares that he owns out of that 100, which makes him a 50% owner. That's 25% or more. So he is self-employed. And then in Part 3, we're going to start talking about the income. So on line 1, we're going to see ordinary business income. And I can actually start gathering information we're going to use to calculate his income in the spreadsheet over here. So let's go ahead and enter that $258,000. And the other thing that I'm going to do while I'm here is take a glance at box 16 and look for any lines that are labeled D. And in this case, I see $150,000 labeled D. And what that is the distribution from the business to Gus. And this is going to tell me already I've got to start thinking about Fannie Mae's requirement that if the income that was distributed to Gus, actually paid out, is less than the profit, the business held on to some of the profit. It didn't give Gus's share of the profits all to Gus. And if I want to use the bigger number for loan qualifying income for Gus, I'm going to have to prove that the business could have distributed this because this number is smaller, what he actually got. And so I know I've got to think about that. I'm just going to park this information about the distributions right here. And then I'm going to jump back up now to that front page, to the beginning of 1120S, and we can start gathering a little bit more information. So first of all, like we said before, this is basically a little profit and loss statement. The first 6 lines are income. We've got income reported here. And then the next line 7 through 22, I guess 7 through 20 are the expenses. And then the income minus the expenses, that's the ordinary business income, the profit that was split between Gus and his business partner, Max. And we've already seen Gus's income. Max would have had a K-1 statement that probably looked a lot like Gus's. So let's start at the top. We have $1 million of gross receipts. And the first thing we notice as we start scanning down is that we do have some other income. And remember, other income, if it isn't recurring, we can't use it. I made this and I didn't make a statement that would tell us what it is, but let's assume it's not recurring. And we've got to subtract that. So let's enter that in and subtract that out from the K-1 income. So that's going to be part of the adjustments that we're going to make. Now, the next thing we want to look for is depreciation. And most of the time, that's going to be right here on the front page on line 14. We can see there was $30,000 of depreciation. So let's gather that information here. Now, this is a fast food restaurant, not mining, not cutting timber, not quarrying. So we can kind of know there isn't going to be any depletion, and there's hardly ever any amortization. But if we were going to really go looking for these things, you'll notice that there's a really prescribed list of things, a lot of things the IRS kind of gives you and says, okay, if you have any of these expenses, enter them on these lines. But most businesses have a lot more varied expenses that are specific to their business that aren't going to fit on any of those lines. And so it is really common to see what we're going to see here. And that is a pretty big deduction of expenses on line 20, other deductions. And we see $136,000 of other deductions. So what is that? Well, there's always going to be, as the line says, a statement that itemizes out what those other deductions are. And that's usually way at the back of the return. So if we scroll all the way down, we should find a statement that itemizes out that other $136,000 of expenses. And that's actually where we're going to find things like theft, like depletion, like amortization. We don't have any of those in this instance. But what else do we have? Well, we have something that catches my eye here, 50% meals with this $10,000 line item. As is almost always the case, if you're trying to write off meals, the IRS is not going to let you write off 100% of them. In this case, the CPA has very helpfully told us that we have 50% that was written off. That means there was an equal amount that wasn't written off. And we have to make an adjustment for that extra $10,000. So we're going to make that adjustment right here. And then we have to go looking for those pesky notes payable in under a year. And where we're going to find that, and where you really want to look at your own tax returns for your own business and see what's there, is on Schedule L. Just like the front page of the tax return is basically a profit and loss statement, Schedule L is a balance sheet. It's even labeled as a balance sheet. I did a bad job of making a balance sheet here, but I just wanted to illustrate this one line item. So yours will probably have a little bit more going on. But what are we looking for? Well, we want to go down to liabilities. and we want to look for line 17, mortgages, notes, bonds payable in under a year. And we want to look at column D. Column A and B is the end of last year. Column C and D is the end of the most recent year. When I say last year, I mean the previous tax year. So in this case, 2022. At the end of 2023, this is where everything stood. And there is $375,000 listed here as notes due in under a year. If we plug that in here, we are adjusting $455,000 of loss. This business looks like it's losing loads of money. And remember when we looked at what the actual profits were, no, it made $516,000. And so you can imagine how maddening it is for a lender to say, hey, your business is actually losing money and I'm having trouble qualifying you for a mortgage. And the trouble comes in really two forms. This debt is something that could just be rolling over. Maybe the business has a line of credit and it isn't actually going to have to write a check for $375,000 in the last year. And I should say, this is a balance sheet. So this isn't cash flow that happened in this past year. But what we're worried about as a lender is if the business has to write a $375,000 check in the next 12 months, that could create a real cash flow crunch. And that's why we're deducting it from the income. But if it's a line of credit and it rolls over and you use it, pay it, it doesn't ever have to really be paid in full, then okay, great, we don't have to deduct that. Or maybe it's a mortgage. And this is the thing I see CPAs do quite a bit, where they'll list the whole balance of a mortgage that isn't due in the next year on this line item as though it was due in full in a year. And in this case, that's probably what's happening because I can see that there's a building that the business owns up here. It's listed up in the assets on this balance sheet. So more than likely, it would make sense that this $1 million building had a $375,000 mortgage on it. So we probably don't have to deduct that $375,000. We probably don't have to make that adjustment. But to know that, we're going to need Gus's CPA to tell us what's going on that line and say, oh yeah, that's a mortgage, or oh yeah, that's a line of credit. And CPAs, as I mentioned before, are not crazy about writing letters for lenders. So if you see on this line 17, a fairly big balance, talk to your CPA, ask them what's on there, ask them why it's there, and ask them if it has to be there. If it isn't really due in the next 12 months, get it out of there and put it someplace else. It doesn't matter what other line it's on. Or if it's a revolving line, make sure your CPA understands what that is so that you can get the letter that your lender is going to need to get rid of that, not include that as an adjustment, and not take, a huge, huge chunk out of what your business's income is going to be. So let's assume we got that letter from Gus's CPA. Well, now we're showing we had $258,000 of K1 income. Thank goodness we're not showing a loss that's bigger than that, but we still have $80,000 of adjustments. Now, what do we do with those? Well, Gus only owns 50% of this business, so we have to make a proportionate adjustment for Gus's share. Only half of those adjustments, that $80,000 we're taking away in income, is really Gus's. And so if we adjust that by 50%, then we have $40,000 that's going to come off of Gus's $258,000 of K1 income, and we have $218,000 of additional income, maybe, because only $150,000 was distributed. And so we need to figure out which one of these two things are we able to use for loan qualifying income. Now, this gets into the liquidity analysis, if income was not dispersed to Gus, if it wasn't actually paid out, then we need to show that the business could have paid it out. And that liquidity analysis is a subject for another video. This one's been long enough, but I do want to show you the logic that we follow as we look at this some kind of a decision tree, I guess a flow chart for how are we going to figure out what we're using. So let me share that, and this will be a little bit of a preview for another video that I haven't yet recorded on liquidity analysis, although maybe I have by the time you're watching this. So I made a little flow chart. If we start by just calculating adjusted K1 income, we just did that, check that off our list. The next question we want to ask is the distribution method required? Do we care about distributions? Because remember, if this is an FHA loan, we don't care about distributions. We can just count the K1 income, this $218,000 at face value, and we're good to go. But in this case, this is a conventional loan. So yes, we do care about the distribution method. That's what we're using. And then we want to know, are the distributions more than the adjusted K1 income? Because if the distributions were more than the adjusted K1 income, then we're just going to use the K1 income. More income was distributed than there were profits, so we're just going to use the profits. They were probably distributing some retained earnings from a prior year. We just use the adjusted K1 income and call it good. But in this case, we have more profit than we had distributions. So we have to keep going. And the next question we want to ask, and this is because we don't want to torture you and we're lazy, is can we qualify Gus for the loan that he wants using just the distributions and the W-2 income? If the loan he wants is something we can qualify him for with just the distributions and the K1 income, there's no reason to work harder and do this liquidity analysis, and we can just go straight to using the smaller distribution number. But if we need that additional income to qualify Gus, or it benefits him in some way, the next thing we want to look at is Schedule L filed? And in this case, we can say, yes, Schedule L was, and the liquidity analysis, future income, will be performed using the information on Schedule L. But businesses that have less than, I think it's $250,000 of revenue aren't required to file a Schedule L. So if your business has less than $250,000 of revenue, your CPA is probably lazy and doesn't want to do unnecessary work too. And they're not going to complete this form. The IRS doesn't require that they do it. And so, no, there isn't going to be a Schedule L for us to complete an analysis. And we need to do your liquidity analysis using bank statements, usually 3 months of bank statements. And when we do that, and that'll happen in another video, then the question is really going to be, did we meet our liquidity? And if we did, then we get to use the adjusted K1 income, the bigger number. If we did not pass the liquidity test, then we only get to use the distributions. And that's going to make this decision as to when we go back up here, what are we going to be adding to our W-2 income? Because remember, we do get to count that W-2 income. So we've got $150,000 of W-2 income. So what do we get to add to that? Are we going to be adding distributions, or are we going to be adding the adjusted K1? And in this case, this is pretty good income. If we just use the distributions, that's $300,000 of income. And we only have to look at 1 year of tax returns for Gus's income calculations. So we can do a 12-month average, and that's $25,000 a month, which is quite a bit of loan qualifying income. But if we need more and we did the liquidity analysis and we could use the adjusted K1 income, oh, it looks like I've got a spreadsheet problem, don't I? Oh, well, that's fun. That should be $218,000. I'm just going to cheat. And he would have $30,000 of additional income. I'll fix my spreadsheet before I send it to you. Now, the next question that we have is, let's say this was an FHA loan and we needed to do 2 years of analysis, or let's say the business was only 2 years old. Let's real quickly do 1 more year of tax returns just to kind of give you the feel for how we do this. So let's go to Gus's 1040. And we're going to see something pretty similar, $150,000 of W-2 income. We've got that extra $201,500 coming from up. Here we are, Schedule E, page 2. And we've got our $201,000 that we know is coming from a K1 from an S corporation. And on page 1, we see we've got the same $150,000 of salary. That's pretty common. A lot of folks just set a salary and pay themselves whatever. So in this case, every year Gus is paying himself $150,000. And here's his W-2 showing that. Okay, cool. We've got what we need out of those personal tax returns. And now we want to look at the corporate returns. And in this instance, we're going to go down to our K1, just like last time. And we're going to go up. We've got still 50% ownership and $201,500 of income from K1, and we don't have any, I didn't mention this before, but we could have real estate rental income or losses. In this case, we don't have that in either one of these years. And so, great. That's what and we've got to look at our distributions. So again, we have distributions that are lower than the amount of profits. So the business retained some earnings or did something else with them. And we have to think about that distribution method and liquidity. And if we go back up to page 1, we're going to start looking for our other adjustments. And hey, we have another $100,000, but it's not the same as the previous year, and it's probably not recurring. This is a net gain from the sale of something. So maybe the business sold equipment, maybe for, I don't know, manufacturing meth. Just kidding. Maybe the business sold a building, something like that. It had some profit, but that isn't really from the ordinary operations of the business. And so we have $100,000 we have to take away. We have $35,000 of depreciation that we get to add back. And we're hardly ever going to have all these oddball things that don't show up very often, but we definitely need to go take a look at where this $156,000 of other things came from, and we get our statement. And the statement is going to show us, I love this CPA for very conveniently telling us that in 2022, 100% of the meals were deductible. And there were some COVID rules that made that possible. So that's not that surprising to see, which means we actually don't have any adjustments that we need to make here. We don't have any non-recurring expenses. And so we're just left with this pesky darned $350,000 of notes payable in a year. And just like last time, we would be back to the CPA asking the same questions. One letter would cover 2 years if we happen to have to analyze 2 years, because boy, that does blow a hole in our profits. Like that completely wipes out all of the profits. Half of that would, in fact, let me put in the 50%. And you can see the business actually lost $6,000 if we have to count that as an expense. Now, maybe Gus would qualify with that if we had to, count that loss, but it would be nice not to have a $350,000 deduction from the business's income. So we'd try and document our way around that. And then we had the same $150,000 of W-2 income. And in this case, let's assume that we can figure our liquidity analysis, past that and run through. Well, then we would have, I've got another, that should be 169,000 formula problem I have to fix, but he would have $319,000 of adjusted income. And if we average that over 24 months, he's got $28,625 of income. So I hope this has been helpful. I hope it gives you a little bit of maybe a better understanding of how your CPA is putting your income tax return together. And I appreciate your time watching this video. Thanks so much. And reach out anytime you have questions.